Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, hello to you. Thank you for being with us. Certainly interesting when we get these figures and these quotes coming through from Russia, really seeming to jump on board.
Yeah, people are just waiting to see whether Trump is going to say something, be called out of his corner to say something that he perhaps doesn't mean or be misconstrued. But yes, markets right now are very, very quiet in the late going, largely because of a lot of these quotes. People just can't keep up with them all.
Absolutely. We are seeing crude returning back above that $50 level. Do you see those indicators, that trend line, the macro supports continuing to be bullish for oil?
Yeah, I do. I'm constructive on oil. I'm not as excited about it as I was at the beginning of the year. I still maintain that we'll probably see mid to late 50s or upper 50s by the year end, but it's going to be slow going. We are positively correlated to the oil price, at least global equities are, so it's a good thing. Just the recent report that came out, the inventory report, where exports surged, imports were down. This is all good news for the price, at least in the U.S. And so I do think we'll continue to be in a very narrow but volatile trading range.
Interesting also, we are seeing this bump up in oil prices feeding through into equity market performance today when it comes to those U.S. indexes. The energy space, the banking space, all helping really push the Dow Jones back into black. Give me your take on today's trade, broadly speaking.
Yeah, well, today's equity trading, really, it's still the two underpinnings that are within the market, the one being Washington, D.C., the other one being, nominal growth metrics around the world. And I don't think that Washington can really upset the market near term. I think it's just going to be holding the market up because people are wishing for tax reform, et cetera. On the other hand, nominal growth, there's a big disparity between the really hard numbers, the PMIs, the industrial production numbers, and the soft numbers. It seems like those soft numbers, the consumer confidence, et cetera, are a lot more optimistic and perhaps more complacent than the real numbers. So anyway, all that to say, I think investors are trying to figure out whether this economy is continuing to accelerate or are we stable. I tend to think the latter, but that's what's going on, at least today, in the equity markets.
Well, and just on that idea of equity strategy, perhaps, as flagged, we do have the banks really helping support some of those gains today. And you, Larry, my understanding, banks remaining one of your main global overweights when it comes to that portfolio diversification and approach to equities.
Yeah, absolutely. I continue to be overweight banks, and you're right. Globally, not just here in the U.S. And I just think that in the U.S., too many people look at the shape of the yield curve, and we're not steepening enough, and so therefore banks should go down. And I tend to not look at that, but look at more direction or momentum of interest rates. And right now they're stable, so that's good for the banks. And we'll keep in mind European equities about 2 years behind the U.S. in terms of our employment-led recovery. So I think valuations are extremely underpriced for the banking sector in Europe. They're underpriced for a reason, but I do think long-term it's a very good investment.
Larry, I'd also love to get your take on emerging markets. Capital Economics coming through with a note saying that patience could be a virtue for investors when it comes to their approach to EM equities. What's your stance on this?
Yeah, so I went overweight emerging markets March 14th on this show. My reasoning was that the dollar has been stable. It has overshot quite a bit, but seems to be stable. The valuations in the emerging markets generally are very, very cheap. And I tend to take like a top-down approach and see this trend in place, and thinking that these stocks have gone down so fast, so far, so furiously, that it's time to get back in. And so that's why I'm overweight emerging markets, especially China.
You touched there on the US dollar. We are seeing the US dollar index hitting a 2-week high, shifting back above that 100 level. What are you making of this, and also how does this movement feed in with your idea of dollar stabilization?
Yeah, no, that's a good question. I think today is just like an aberration. You can't just blame it on the weak German inflation data, but here I am doing so. Just because I think there's just a reason people are expecting so much more out of that inflation number. Came out a little softer than expected. And also the GDP in the U.S. was revised up to a whopping 2.1%, with consumption revised from 3 to 3.5%. So that's enough to give the dollar a real tailwind today.
Larry Shover, we are out of time, but thank you so much.